Right now, there is a company out there that's, well, essentially acting as a secretive, privatized branch of the United States Defense Department.
Yeah, that's really what they've become.
Right. I mean, they build the digital architecture that intelligence agencies use to map global threats.
Mhm.
But suddenly, hospitals, manufacturers, and, logistics companies are just tearing the doors off the hinges to get their hands on this exact same technology.
Which is wild to see.
It's totally wild. Their stock has exploded over 63% from its recent lows. Yet, simultaneously, the most famous short seller in the world is betting millions against them, and the company's own insiders are selling off massive blocks of shares.
A lot to unpack there.
Exactly. Today is August 21, 2026, and we are looking at the absolute watershed moment of Palantir Technologies.
It really is a profound contradiction playing out in the market right now. I mean, we have this stack of SEC filings, equity research, financial news in front of us, and the data paints a picture of a company actively trying to rewrite the rules of enterprise software.
Yeah, they're not playing the same game as everyone else.
Not at all. They are attempting this massive pivot from a very controversial, slow-moving government contractor into basically the indispensable digital backbone of the modern commercial world.
And that is exactly our mission for this deep dive.
Yeah.
We're tearing into this stack of research to figure out what this pivot actually means for you.
Right.
We need to find out if Palantir's massive recent surge is the dawn of a generational AI monopoly like a company that will define the 2030s, or if it is just a fundamentally overvalued bubble primed for a spectacular collapse.
The stakes are pretty high.
Huge. So we are cutting through the noise, the hype, and the fear to understand the actual mechanics of what this business is doing.
And to really ground this, we should look at where the stock is sitting at this very moment. It is at $173.71.
Right.
That represents nearly a 29% surge in just the last 13 weeks.
Which, I mean, that defies the traditional gravity of a company this size.
It really does.
When I look at this growth, my immediate fear is kind of the 1999.com trap.
Oh, absolutely.
I see these numbers and I instantly think of companies faking top-line growth by spending heavily to acquire unprofitable customers. Because, well, the catalyst driving all this current hype is Palantir's staggering Q2 2026 earnings report that just dropped on August 3rd.
Yeah, that earnings report was a shockwave.
Okay, let's unpack this because the raw numbers are almost hard to process. In the first half of 2026, their revenue hit $3.568 billion.
Wow.
That is an 89% increase year over year.
Let's break down what that 89% is actually coming from, though, because that holds the key to this entire narrative.
Right.
Historically, the prevailing criticism, like the main bear case against Palantir, was their over-reliance on government contracts.
Which are notoriously unpredictable.
Exactly. Government revenue is super lumpy. You spend years navigating security clearances and bureaucratic red tape. You win a massive contract and then...
And wait.
Yeah, you might wait 3 years for the next one. It is not a smooth, predictable growth curve at all.
But looking at the breakdown here, their government revenue grew 79% year over year, which is massive on its own.
It is.
The commercial side, however, is what completely shattered expectations. U.S. commercial revenues surged 149% year over year.
Incredible.
And they are guiding for over $8.15 billion in full-year revenue. I mean, to put that 149% commercial growth into perspective, a mature company making billions of dollars shouldn't physically be able to double the size of its commercial footprint in 12 months.
No, usually that breaks the internal infrastructure.
Right. It's like watching a massive heavy freight train suddenly accelerate like a sports car. And their trailing 12-month revenue growth is sitting at nearly 79%.
The mechanism behind that acceleration, the reason they pull that off, is their artificial intelligence platform, or AIP.
Okay.
For years, Palantir operated almost like a high-end consulting firm. They had this incredible data integration software built for the CIA, but to implement it, they had to send what they called forward-deployed engineers to live at a client's headquarters for months.
Oh, wow.
Yeah, just custom wiring everything. It was brilliant, but it was not easily scalable.
So it basically required human labor to install the digital plumbing.
Yes, exactly that. AIP changes that dynamic entirely. They have successfully packaged that incredibly complex military-grade data integration into a scalable enterprise platform.
Okay, so it's out of the box now, sort of.
Sort of, yes. They are selling it to commercial sectors, healthcare, manufacturing, supply chain logistics. And the adoption rate proves that they have cracked the code on making it deployable without needing an army of engineers on site.
The research talks a lot about their specific ontology.
Yes, that's a big buzzword for them.
I think that term gets thrown around in boardrooms a lot,
Yeah,
but understanding it is crucial to understanding why hospitals and the logistics companies are suddenly paying a massive premium for this.
definitely.
Because everyone else in the tech world is trying to build a smarter blender or, a better toaster.
Right, the specific AI applications.
Exactly. The chatbots, the image generators. But Palantir isn't building the toaster. They are laying the copper wiring inside the walls of the enterprise so that whatever appliance you plug in actually
Yeah.
gets power.
That is a great analogy.
Thanks. So ontology is essentially how the software translates messy, disconnected real-world relationships into a language the AI can actually understand.
That is the perfect way to visualize it. I mean, think about it. If you are a massive hospital network, you have data in thousands of different formats.
Right, it's a mess.
Staffing schedules, patient records, supply chain deliveries, maintenance logs. If there is a delay at a shipping port in Los Angeles, standard software just sees a delayed shipment.
Okay.
Palantir's ontology connects the dots to tell the hospital's AI, hey, because of this port delay, you will have a shortage of a specific surgical tool in operating room 3 next Tuesday, so you need to reschedule these specific elective surgeries.
Wait, really? It maps it out that far?
Yes, it provides the context that raw data just lacks.
That's insane. But, okay, this brings me back to my earlier skepticism. So what does this all mean for the actual business? Scaling that kind of complex architecture at 149% commercial growth sounds unbelievably expensive.
It does sound like it would be.
Right. So if they're growing this fast, are they actually keeping any of this money, or are they burning through cash to fuel the illusion of a breakout?
What's fascinating here is that we have to look at a financial mechanic called operating leverage.
Okay.
The metrics they reported are staggering for a software company scaling at this velocity. They achieved a gross margin of 84.8%.
Wow.
And their trailing 12-month net margin is sitting at 49%.
I want to pause on that 49% net margin because that is a vital metric for you listening. That means for every single dollar Palantir brings in the door, after paying for the servers, the engineers, the marketing, the
And everything.
nearly 50 cents is dropping straight into the bank as pure profit.
Yeah, software is beautiful because once you write the core code, copying it and distributing it is essentially free. But as we discussed, Palantir used to act like a consulting firm, which killed their margins. The 84.8% gross margin tells us they have completed the transition into a true software-as-a-service model.
So the heavy lifting is done.
The core architecture of AIP is built. So when a new commercial client signs a multi-million-dollar contract today, the cost for Palantir to service that new client is practically zero. Every new dollar of revenue is pure margin expansion.
The actual dollar figures back this up completely. I mean, they generated $1.932 billion in net income in just the first half of 2026.
Which is huge.
This isn't just some one-time accounting trick either. It marks their 12th straight quarter of profitable growth. And looking at the lifeblood of any business, the operating cash flow, it grew 149% to $2.115 billion.
That's the real metric to watch.
The cash flow is actually growing faster than the revenue itself.
Which leads directly to the state of their balance sheet. They are sitting on over $2 billion in cash and cash equivalents.
Unbelievable.
And some research estimates from U.com suggest that if you factor in their short-term investments, their actual liquid war chest might be up to $9.2 billion.
That is just
And crucially, they have zero long-term debt.
zero, meaning they are entirely insulated from the credit markets.
Completely.
If interest rates spike or the broader economy tightens up, Palantir just doesn't care. They don't need to borrow expensive money to keep the lights on, and they don't need to dilute their shareholders by issuing new stock to raise capital. They are a self-funding machine.
Exactly. And with that kind of war chest, the conversation naturally shifts from what they're doing today to what they're capable of doing over the next 2 to 5 years. The market is clearly looking past the current quarter and pricing in a massive paradigm shift.
Here's where it gets really interesting. Let's explore that 2 to 5 year horizon, starting with the optimistic blue sky scenario outlined in the research.
Yeah, this is fascinating.
They are targeting an emerging concept called defense industrial base digital twins.
Right, a digital twin. Basically, it's a living, breathing virtual replica of a physical system.
Like a simulation.
Yeah, exactly. For the defense industrial base, this means simulating entire supply chains, weapons manufacturing facilities, and even active battlefields in real time.
Wow.
If a geopolitical event disrupts the supply of a rare earth metal, the digital twin instantly calculates the cascading impact on missile production schedules down to the minute.
And the research ties this directly into a much broader and honestly fascinating geopolitical theme. AI sovereignty.
Yeah.
This feels like the core thesis of their long-term value.
If we connect this to the bigger picture, AI sovereignty is the realization by allied nations that their digital infrastructure is now as critical to national security as their physical borders or their energy grid.
Absolutely.
In the 20th century, nations fought for oil sovereignty. Today, a nation cannot rely on standard, off-the-shelf, potentially vulnerable public cloud infrastructure for intelligence operations.
Imagine a scenario where the U.S. military or an allied intelligence agency is using a commercial cloud provider's AI to track troop movements or analyze drone footage.
It's a nightmare scenario.
What happens if that cloud provider gets hacked? Or what if the tech company's board of directors simply decides they no longer want to support military contracts and changes their terms of service?
Right. We've seen internal tech employee pushbacks before.
That is an immediate, catastrophic national security crisis.
So Palantir's entire pitch to these governments is basically, we are the digital vault that answers to no one but you.
Which is exactly what they want to hear.
Exactly. Given their long, deeply embedded history with U.S. intelligence agencies, they are trusted in classified environments where traditional Silicon Valley tech giants simply aren't allowed to operate.
But this massive valuation assumes they are invincible. And, they aren't. Big tech, the Amazons, the Microsofts, the Googles, already own the cloud infrastructure.
The servers where all this data actually lives?
Exactly. The research highlights a major bear thesis here involving these hyperscalers. What stops Microsoft or Amazon from just building this AI plumbing themselves?
That's the million-dollar question.
If 95% of software eventually becomes commoditized, standard AI middleware, and Microsoft decides to bundle it for free with their enterprise cloud storage just to kill Palantir's moat, why would a commercial client continue paying a massive premium for Palantir?
That is the existential plumbing threat right there. If organizing data and deploying AI becomes as standardized and ubiquitous as email, Palantir's 85% gross margins will inevitably face crushing pressure from the sheer scale and brute force of the hyperscalers.
Because you can't charge a premium for a utility that someone else is giving away for free.
Exactly. But the counter-argument embedded in the current data is that enterprise customers are finding out the hard way that the hyperscalers' built-in tools are simply not adequate for complex, mission-critical operations.
They just don't cut it.
No. The 149% commercial growth rate suggests that when a hospital network tries to use off-the-shelf AI to manage surgical schedules, it fails.
I see.
Palantir is winning right now because their ontology is incredibly difficult to replicate, and once a company integrates Palantir into its core operations, the switching costs are astronomical. You cannot easily rip out the nervous system of your business.
Which brings us to how the stock market is actually digesting this tug of war between fundamental dominance and looming big tech threats.
Yeah, the market reaction is fascinating.
Technically speaking, the stock is heavily overbought. The relative strength index, the RSI, is sitting at 78.23.
Which is high.
Anything over 70 is traditionally a signal that a stock has run up too far, too fast, and is due for a violent pullback. But I want to dig into the valuation because, honestly, how could anyone justify the current multiples?
It's tough.
We're looking at a price-to-earnings ratio of 143 times. And even more shockingly, a price-to-sales ratio of 70 times.
Let's translate that price-to-sales ratio into reality for a second.
Please do.
A multiple of 70 means investors are willingly paying $70 today for every single dollar of gross revenue Palantir generates over a year.
Just top-line sales, not profit.
Not profit.
Just sales.
Even if they execute perfectly, hasn't the market already sucked all the future profit out of the room? I mean, you are paying for a decade of flawless execution up front.
It is the definition of being priced for absolute perfection. In the software sector, a price-to-sales multiple of 10 or 15 is considered aggressive.
Right.
70 is just astronomical.
Yet the research from Benzinga points out there's reportedly $12 billion in short interest against the stock, investors betting that the price will fall.
Yeah.
But those short sellers have bled $5 billion in losses recently.
Which introduces the mechanics of a short squeeze, adding artificial rocket fuel to this rally.
Okay, explain that.
When an investor shorts a stock, they borrow shares and sell them, hoping to buy them back later at a lower price. But if the stock price surges instead, like a 29% jump in 13 weeks, those short sellers face infinite potential losses.
Their brokers force them to buy the stock back at the current high price to cover their positions.
So the people betting against the stock are forced to buy the stock, which drives the price even higher, forcing more short sellers to buy in.
Exactly.
It's a feedback loop of panic buying.
A feedback loop that completely disconnects the stock price from underlying fundamentals. The price is being driven by market mechanics, not just earnings growth.
That structural mechanic makes sense of the price action, but it leads to a glaring, massive contradiction in the data.
The insider selling.
Yes. If the company's genuinely this strong, if the cash flow is exploding and the commercial adoption is real, why is insider sentiment terribly negative?
That's a fair question.
The data shows 0 open market insider purchases. None. But there have been 20 insider sales totaling nearly 260,000 shares. Combine that with the news that Michael Burry, the famous big short investor who made billions predicting the 2008 housing crash, is reportedly buying put options against Palantir. Are the insiders and the institutional bears seeing a cliff that retail investors are completely ignoring?
We have to evaluate insider selling objectively because it is easily misinterpreted. Heavy insider selling at these extreme valuations often comes down to personal wealth management and tax mechanics.
With stock auctions.
Right. In the tech industry, heavy stock-based compensation is the standard. Executives receive restricted stock units, or RSUs, as a large portion of their salary. When those RSUs vest, they create a massive tax liability.
Okay.
Executives routinely have automated trading plans set up to sell a portion of those shares simply to pay the taxes on them. Furthermore, if you are a Palantir executive and 90% of your personal net worth is tied up in company stock, standard financial prudence dictates selling some shares to diversify into real estate or index funds after a 63% run-up.
So an insider selling isn't necessarily a signal that the core business is failing, but the lack of any insider buying is telling.
Exactly. The lack of buying confirms that the insiders understand the math of their own valuation. They know the stock is expensive. Even if the underlying business is incredibly healthy, the stock price carries an immense risk of multiple compression.
Meaning?
Let's say Palantir misses an earnings estimate, or their revenue growth simply decelerates from the current 89% down to a still respectable 50% year over year.
Growing at 50% is still an incredible achievement for most businesses.
But not for a business trading at 70 times sales. If growth decelerates to 50%, the market will violently reprice the valuation multiple. Investors will decide they are no longer willing to pay 70 times sales, they will only pay 25 or 30 times sales.
Ouch.
The stock price could get cut in half overnight, even while the actual company continues to generate record profits and pile up cash. The underlying business and the stock price are two entirely different mechanisms right now.
That explains why a value investor like Michael Burry would target it. He isn't necessarily saying Palantir is a bad company.
Yeah, no, not at all.
He is looking at the asymmetrical downside risk.
Yeah.
He sees a tightrope walker performing a flawless, spectacular routine, but doing it without a safety net.
Exactly.
The slightest gust of wind, a single quarter of decelerating commercial growth, and the fall will be brutal.
That perfectly frames the dynamic. The fundamentals we reviewed are superb. The cash flow is elite. But the price tag attached to those fundamentals requires them to dominate the AI landscape without a single misstep for the next 5 years.
Bringing this all together for you listening, the core takeaway from this stack of research is that Palantir is executing its business model almost flawlessly right now.
Absolutely.
They have proven their commercial AI thesis by translating their military-grade software into a product that commercial enterprises are adopting at a triple-digit growth rate.
Which is no small feat.
And they have decoupled their revenue growth from their operating costs, turning the business into a multi-billion-dollar cash machine. But the stock market is fully aware of this execution and has priced the shares for a near-perfect future, creating a massive risk of a sudden correction if momentum slows.
Which means your attention needs to be hyper-focused on the next incoming data point.
Yeah.
The critical event to watch is their Q3 2026 earnings report.
Okay.
Management has laid out clear guidance for $2.16 billion in revenue for the quarter, but hitting that top-line number is only half the test.
The real test is the composition of that revenue.
Yeah.
We have to see if the U.S. commercial growth maintains that triple-digit momentum.
Precisely.
If commercial growth holds steady or accelerates, it validates the thesis that AIP is experiencing structural, permanent adoption as the new operating system for the enterprise.
But if that commercial growth decelerates sharply, the market will immediately question whether this was just a temporary spending wave by corporations panic buying AI tools just to satisfy their boards of directors.
A sharp deceleration in commercial growth is the primary risk signal that could trigger the valuation collapse we discussed.
Exactly right.
Before we wrap up, I want to leave you with a final thought to mull over. building on that concept of AI sovereignty we talked about.
Sure.
If Palantir truly executes on this blue sky vision, if their ontology becomes the exclusive, deeply embedded digital brain for the U.S. military, the intelligence community, and the defense grids of our allied nations, do we eventually have to stop evaluating them as a traditional publicly traded tech stock?
It really forces a complete rethinking of traditional market mechanics.
At what point does a software company become so inextricably linked to the survival, logistics, and combat readiness of national security that it essentially functions as a privatized, untouchable digital branch of the Defense Department?
It's a wild thought.
And if a company reaches that status, how do you even begin to place a traditional price-to-earnings multiple on an entity that the federal government literally cannot afford to let fail or fall into foreign hands? You wouldn't try to calculate the price-to-sales ratio of an aircraft carrier.
Very true.
It brings us right back to the beginning. Are we watching Palantir defy financial gravity? Or are we witnessing the creation of a completely new set of rules for a new era of digital defense?
How the market answers that question will likely define the trajectory of not just Palantir, but the entire defense technology sector for the rest of the decade.
Thank you for joining us for this deep dive into the filings and the financials. Keep questioning the numbers, keep an eye out for that Q3 commercial revenue breakdown, and we will catch you next time.